Okay, recording has started. It is June 8th, and I'm Tim Quast, and this is the live Market Structure Edge discussion and demo. Thank you for being here. Let me get rid. I hope this doesn't stop it. That. And I have got, as usual, I aim for 4 or 5 key things to talk about, and I make sure that I go back and look at the Edge Market Desk notes to be sure that I cover the things that I said I would. So I want to talk about the importance of demand and supply over price again, because I'll tell you, I trade emails with a lot of users, and it is the number one thing that I get is, well, I haven't done anything yet. I haven't made a decision yet. So I want to talk about that. For you veterans who are already very comfortable, as I am, I don't overthink it at all. Sometimes that's not so good. Most of the time it works out. So I want to do that, and I want to talk about the current broad sentiment context divergence and how quickly it changed. I mean, it was really something how fast things have changed. When to enter and exit. What I mean by this is I get a lot of questions about this, and you folks, Tim, Steve, John, Dan, you guys probably you don't even think about this. What you're going to do if you have a position that you're going to build and when you start doing it. But a lot of people struggle with that. I'm not saying I have all the answers by any stretch, but I can certainly offer my view, and maybe you guys can weigh in and offer a perspective too, because people listen to this replay. Refining our approach. I said we would talk about that. I've got some thoughts there. And then finally, next, what's coming next? And it's a busy macro calendar coming up. That's the plan of attack. I'm going to share my desktop here. And as ever, if you're new, there are only 2 rules. Mute yourself while we're talking and ask questions. The whole point of this is to have some interaction. And we had quite a bit on that discussion, on the presentation, the webinar yesterday. I think I answered questions for 20 minutes anyway, which was nice. It's like here. It's the best way for the folks who are new to get comfortable asking questions and of course learning things. Okay, so here's what I mean about the importance of demand and supply over price. It's really what I talked about in that presentation. And I see this happen all the time. If the market starts out positive and then immediately dives, then everybody stops what they're doing, because we're watching the broad measures, we're watching the headlines, and we need some signal to tell us that everything's okay. And to me, the point of Edge is to be able to use the power of that stuff to our advantage. If we know that there is a high probability that something's going to move, and we act on it now without respect to the headlines and what the broad measures are doing, look at them. The Dow's up 175 points now. It was down early, right? You wouldn't think that that's where it's going to go unless you looked at the data here. And sometimes it takes a number of days for the signals to play out. But if you looked at broad sentiment this morning, and you said, "Well, it's ticking up," and look at that collapse. That's a Hicks rule for the entire market right there. Rising demand. Now it's not at 10, but broad sentiment's never been at 10. There are too many components, and it's taking an average. Been over 8, been a long time. And this collapse on the supply side, well, that's a pretty good signal that at least somewhere in the number of days ahead, could be today, could be a few days ahead, we're probably going to get a pretty good move. Well, that's what I mean about the importance of demand and supply over price. If you're just watching how prices behave, and I know that you folks who know technicals may disagree with me on this point, but I feel like it's easy to miss out on an opportunity. It doesn't always work, but most of the time it will. That if we see the signals, 19 in momentum, you look across the dashboard, and I'm going to come to this next. We're kind of bleeding 1 and 2 together here. But these things all of a sudden, and if you back up to June 6th, they didn't look like this. There were 9, On June 6th, I could say, well, there's not a lot of momentum. It's a pretty narrow band. Well, the brand has expanded. And looking at these things, if one were to act on supply and demand, you just say, okay, I'm going to go look at the momentum portfolio and I'm going to see which things have characteristics that are pretty appealing to me. They're not all there. The problem with these stocks that aren't up to 10 is they might stop, like this one. Look, sounds like we got somebody. Brian, I'm going to let you, if you would. Yeah, thank you. That some of these things may not ever develop the full, the momentum opportunity. We weighed this. Do we put things that aren't at 10 yet in the list? Well, I think so, so we could at least see if they continue. But you could go in here and say, okay, what things have good characteristics? Well, Qualcomm, you could look at this and say, that is a pretty nice supply-demand divergence there. And Smartsheet has been great. It's not quite as good to me as Qualcomm because it's not dropping right off. This is a trend, but it means it's not quite as good as that, right? That's really good. But you could say, well, that's kind of splitting hairs. My point is, you could pick up 4 or 5 of them, go look at them, and maybe 2 of them have shot out of the gate, and the others are kind of moving around. Maybe one's down. I mean, it gives you an opportunity. You can say, well, if I trust the math, there is a probability that if they have very similar characteristics, they have very similar, they're liquid stocks, they're of size, they have a generally uniform nature to them because we've screened for that probably those things are going to do well. But if you were looking at the price, you might not be disposed to act. And if you do, you immediately have a chance maybe for an entry point. I'll use this as an example.
Hey,
Let me
Tim?
go. Yes.
Oh, I was going to say on the smart sheet, you might want to just mention the warning of earnings.
Good, very good. Thank you for pointing that out. Always check. Earnings are just can chop block you. I still, wake up in a cold sweat over Crocs. I'm kidding. I don't sit and rue what goes wrong at all, but I don't intend to repeat that. But see that's a Freudian slip. So if we look at Smartsheet, you always do. You're exactly right. So Smartsheet reporting results. They reported yesterday. There you go. Yeah.
It's another
very
Crocs.
good to know. Yep. Is that right?
Very minor problems.
Okay.
The analysts are all saying it's still supposed to hit 55 to anywhere between 55 and 60. And
Okay.
they're overlooking their problems. I've made money on Smartsheet this morning. Did real well.
Excellent. Okay, very good.
Any stock that drops over 20% that's on our list with the supply and demand that it's got is going to go back up. So.
Well, there you go. There's some good input. I'm glad you pointed that out. Earnings, very, very important. So here's where I was headed. Let me just do this really quickly too. Let's leave that. We'll do Cloudflare today. It's an example. If out the gate, if you look at the data and you say, well, momentum has improved, and maybe there are some that move right away, and Cloudflare doesn't, it's just kind of hanging around at the same level. Well, to me, that's a great opportunity. And Steve, you have a more refined approach to that, and feel free to offer it, weigh in, and explain what you do. But you could have made 3% on Cloudflare today. Just 3% is 64 and change off of a level around 63.20. 3% on that is, I don't have it right off the top of my head, but call it 64.10, 64.05. Well, it went above that. So if you do, like you say, Steve, you could buy it and put in limit orders up 3%, and you'd have made that much money right there. Then you can immediately turn around and redeploy that in something else. That to me is a great way to think about it. I try to do that. That's as I said, I take a very central tendency approach, but if AMD you got a set of these nice tech momentum stocks and 3 of the 4 are moving up and 1 isn't, well, I'm probably going to take the one that isn't, that may be down a little bit because that's worked out well. It's now I wouldn't want to necessarily be an AMD because look at the supply demand equation. This is another thing to know, the folks who are new to Edge. How do you know when to leave? Well, there you go. I mean, if the demand is falling, the supply is falling too. It doesn't mean the price is going to fall apart because those two things are moving the same direction. Probably price stays level, but it's a reason. It's a very concrete reason to leave because you want to buy the solid or either demand that's rising, supply that's falling, or demand that's solidly at 10 or supply is falling. Those things have a more reliable probability of giving you returns. But if you're fixated on price, you're going to miss out on those opportunities. And the beautiful thing is, as markets turn around, then all those people who are watching prices and do like maybe the same things that you're looking at, then they enter the market and they fulfill your supply demand decision with their arrival. And so it's very, very important to have an advantage over that. Unless you're looking at supply and demand, you don't know that you have this advantage where there is an asymmetry. It's kind of a cliche, but there's a difference between the things that may create an opportunity. And you're taking advantage of all the folks who don't know that. It's helpful.
Hey, Tim,
Anyway, yes, John, is that you? Go for it.
question I had, I have been thinking about, which is if we're starting flat every day and you have the supply demand's weighing in your favor from a divergence perspective, what is that entry point, right? Like if you look at you look at the change compared to yesterday's open, you look at it open to open, in terms of like the volatility and like, going back to that example with net, would you buy that at the open or would you wait for the volatility, to move down? Or would you just assume because it's sitting there and it hasn't really hit its full day's volatility that after a half an hour, it's more than likely to progress higher because to kind of target that?
Well, I'll let you answer. Yeah, and Steve, you can weigh in too. But John, you're a sophisticated guy, and you probably have some opinion. What would you do? I'll give you my answer, but what would you do?
I mean, I would look at it in regards to like the range. Obviously, you're trying to capture some percentage of the range, right? And so I think the biggest thing to do is you have a couple options, right? You could hit it right away, you could scale in. I was just curious, it's kind of what you think is the way to play it, or what you've seen in the data that is successful. So there's multiple ways I think you can do it, right? But just kind of looking at what the group has been doing and find success.
Yep. Okay. Steve, you want to weigh in on that? You're muted. Here, I can do it. I got
There
you.
we go.
Oh,
there we go. Okay. What I do is I watch to see, I'm looking for stocks that are not going up. And that's my whole strategy, is that I copy down the volatility of everything, put my watch list together, and all by percentages, putting percentage change in there. And I watch, and if I have time, unfortunately, I wish we got this information the night before, earlier than 11 o'clock our time. But what I try to do is I try to go in on each individual stock, not when you have 20 of them like we do today, between my own strategy and the others that we use here. But I watch and I would put a line across that's down 50% down from what its volatility is on that stock, on all my stocks. And I've got, I run two computers. One computer has all of the stocks that are in Market Structure Edge using the strategies that I use. And I actually put a line across where that is. And so when I'm watching, like today, there are 20 stocks. I watch for when that gets down to 50%, and then I keep an eye on those particular ones until personally, this is how I do it, until I see two green bars in a row that show enough strength that money is going to start coming back in. And that's when I buy.
Well,
And then
it works very well.
I automatically am set up. I use Thinkorswim, so I'm automatically, when I do a buy, I have a stop limit of 2% up and 1% down. So that's what I do on a everyday basis.
How often do you get stopped out?
Oh, probably about 1 out of every 5 times.
Okay.
So 4 out of 5 are winners, and I lose 1%, but the 5 are 2% winners. So, you know, it works for me.
Very acceptable ratio. Right. Yeah.
Would
That's
you want
good.
that stop to be 1% below the day's volatility from the open, assuming that it's going to trade or close to that range? Like I think that's what you're talking about, Tim. Like if you look at like what all the high frequency guys are doing, I mean, they effectively know that the stock will trade the range. Like I think it was a good example. Not Amplitude is a stock that I bought. Right, it was down twice its daily average range. Right, and literally I only ticked the bottom of the low because I put that order in there. But I mean, the machines are literally almost ticking it to that almost every day. Right. So I think that that might be an interesting thing to look at too, just so you don't get stopped out, right?
And what I do, John, is I put a trailing stop.
Yeah.
So that if it does start to come down, if I go up and it starts to come down, I'm generally not going to lose any more than, 0.5% at the most with a trailing stop. So
well, that's pretty effective. So I would only add that knowing what I know about how prices are set in the market, realize all prices at the open are set by high frequency traders. The 4 DMMs on the floor are they're proprietary traders. They cannot price the open with a customer order. They also have very little incentive to send orders away from the NYSE. They're paid to be 10% of the volume in NYSE issues, which means they're not interacting with all the rest of it. And so it can be deceptive. So, but I know that. So I know what they're doing. Then I know what the NASDAQ and the rest of the markets, they're all time priority market maker models. And that high frequency traders are going to try to move the market within the first 30 minutes to an hour, because it will affect what the reference prices will be in the close. That's where all the real money is. In the last hour, all the money that wants a reference price, that is, they want to track a benchmark, it is all predicated on the prices throughout the day. And who knows that and who's calculating that? The high frequency traders. So knowing that, when there is momentum in the market, the high frequency traders are going to know there are imbalances and stocks take off. Right. Those are the times when I will chase something. The rest of the time, I'm not going to do it. I'm probably going to wait 45 minutes, an hour in, because I'll have a better chance. They'll have moved on to something else. And if the math, of course, is correct, then today or tomorrow, then supply and demand will deliver my return. And I prefer to do what you do too, Steve. I'd like to have down at least half of the volatility, because you have a much better chance of making money. Yours is more precise than my approach, though.
I will add this. I set alerts, and for when it hits that 50% down, because I do other things also in my life. And so it may be 11 o'clock in the morning and I get an alert. So I'll go look at my laptop or at my phone and see how far down it's gone, and kind of keep an eye on that when I'm doing my other job. Photography.
That is good. I have started to do that too. I've got an app on my phone that will tell me when stocks have moved a certain amount, because me too. The hardest part for me is to pay attention, because I've got so many other things going on, and I'm not very bright to boot. So it's hard for me to do more than 80% of one thing at a time. But I hope that's helpful. That would be very helpful to me as a new user. What this discussion right here. It's some of the things that you rarely hear talked about. When should you do something? What is a strategy? How do I know whether I should act, and when do I leave? So thank you for doing that, you guys. Okay, so time's ticking. Let's see. I want to move on to. It's kind of blending together, but let's see, I want to pick these two things up. So just to finish this off, and maybe now it becomes redundant, but I will use, let me go back over here. I thought I would share this with you, and I do it periodically. These are recent trades of mine. And I did, as I mentioned, Steve, I did some of what you did. I bought Rambus, and all I want now is roughly 3%. It was slightly more than that, but I just put in, and I just put in calculated the spread. I'm not using Thinkorswim. I'm using Interactive Brokers, so I had to calculate it myself. But it's nice. I like the fact, and I keep my trades small. Notice I don't have there. If I have a whole bunch of something, I chop them into smaller pieces because I prefer to look like a machine. Is there any advantage to that? I don't know that there is. There is certainly an advantage of putting trades in increments of 100 shares or less at the market, because then this is very redundant for you veterans, but for new folks, I know they have to get filled, and someone's going to cross the spread and give me a little better price. That's what high frequency traders do. Since I know it, I might as well use it to my advantage. So I bought AMD the same way that you see these cells. So I executed these, but there are two things to know. Once I've hit my target, then I'm out pretty quickly, right? And you have, of course, if you set them up automatically, that's going to happen anyway. Notice where they all executed. Dark pools, dark. All dark means is this is a broker-dealer operated marketplace, an alternative trading system. Here's internalized. My own broker bought 49 shares from me. But that they couldn't find a better price than the one that they couldn't find a better price in the market, and it must be immediately executed. So if they couldn't send it out someplace, they're forced by law to buy it from me. Well, I know that. So do all the high frequency traders. They stick other people with trades. Look at this. I bought J&J, so I bought that in increments. I bought 50 shares. 49 shares were executed in the dark. 1 share executed at a different dark pool. How did that happen? It's an intermarket sweep. It's just sweeping through, picked up 1 share, price changed. So that's all that filled. Well, it happens all the time. But it's very interesting to note that there were only 2 trades that executed at exchanges in this entire set. Bats down here sold 99 shares at Bats. That was my broker's algorithm routing it out, saying, well, thank God we don't have to take the other side. and then up here, Direct Edge. Both of those are owned by SIBO. So my limit order to sell up 3% in Rambus, I didn't have very much of it. You can see I just had 99 shares. But, it produced a good enough return. And if you repeat those over and over and over, pretty soon it begins to accumulate. And it's far better than betting on Crocs. I can tell you that. I can make all of the losses on Crocs up by being very disciplined in taking those 2 or 3% like you do, Steve. It's less stressful and it's consistent. So that's to me the best thing to do. Buy half the intraday volatility. If you're new, I'm going to go back to that and just illustrate it. What we're talking about is the volatility metric in here. That's this read right in the middle there. And it's a pretty good idea of what you can expect to get. If the stock goes down all of its intraday volatility, it could happen again tomorrow. And it does occasionally, but there's also a very high probability that you're going to get that back. AMD was a great case in point. It's my one rub with I could have limited my risk because AMD went down, I don't know, 5-6%, even beyond where I bought it. But then it ended up recovering all of that and going up 4% anyway. And so most of the time, the math will be right. I would look at the math, say still a 10, supply is still falling. I'm going to trust that the supply-demand equation will deliver. It's better. It's really better to do what Steve does. It's less stressful. But if you don't worry about it, and if you believe that the math is pulling in the right direction for you, and all of the signals were there, tech was still the place to be. Tech was still the best sector. The broad market had bottomed. Supply was starting to come down. I look at all of those and say, man, the math is really stacked in my favor. Might as well just not worry about it. And sure enough, there are easy, maybe, as I said, less stressful ways to go, but that is very reliable. So if you're trading, let's say Qualcomm, and it goes down 1.5%, that's a pretty good entry point. And then you could put your, how far from your entry point do you want to go? Well, 3% would be awesome. It's a reasonable outcome. Could you get a 3% return from your entry point? Probably. Might take a couple, 3 days. And look, you may not, but there's a very high probability that you will. And that's the way to do it. Once you do that, take the money, go find another opportunity, wash, rinse, and repeat. And it removes the vagaries from the equation, the whimsical nature of human nature. That's what I think. Okay, so questions, comments. I need to look at do we have questions that need to be answered? Let's see. That's right. Buy divergence options, expirations, and sell it out the other side. And I think that is, we're going to come to what's coming next as the last piece of the puzzle here. Having called right, but it would be really helpful. I agree, John. There are definite refinements we need to do, and I'll tell you, as a business operator, programming is very costly. We have very good engineers, and their time and effort is very expensive. So I very carefully weigh revenue and the investments in the additional development that we're going to do. We never, ever, as I get out over our skis. That's why I've been successful in business. We very carefully manage those things. So all these things that you mentioned, as we're able to do those and make sure that they pay for themselves, we will do them. And I agree that would be very helpful. Please, can you have a look at AI portfolio specifically? Oh, okay, at AI, yeah, C3 AI. Oh, we've got that noise back, don't we? Godwin, I'm sorry to keep doing this to you, but I'm going to mute you again.
And Tim, when you have a chance, I think Godwin has a question, perhaps when you get a chance.
Okay, thank you very much.
He just has his hand raised.
Okay, Godwin, we'll come to you next. Okay, so looking at C3 AI, it's not bad. Would you say that this is enough to leave? Yeah, it just means it's going to be harder for a price to rise, because look how high the supply side is. 57%. It's above the 30-day trend line. I mean, at what point do you leave? For me, if AI is up, and so maybe you didn't get all of your gain. Maybe you were shooting for 3% and it's only at 2. Well, I would look at that math and say, well, maybe 2 is good enough, because clearly the math's beginning to deteriorate. There's no problem on the demand side. And there's no, we don't know. This could drop off tomorrow. That's why, one day isn't a trend. I'll give you Netflix as an example of this. Netflix has produced some very nice returns here lately. And you look at Netflix and say, is that a reason to leave? Well, you get awful close. I mean, if there were another day of that, if there were another day of rising supply, absolutely. Because every time supply runs for a couple of 3 days well over trend, price stops rising. Over trend, price stops rising. If they change, you can buy it again. You can buy it again. But the risk that you lose money increases when this condition exists. So to me, AI reflects those same things. If tomorrow the supply side hasn't reverted, I'd be looking to get, we know there's momentum. So there's a probability that whatever it's doing today, all other things being equal, that it will be up. And I would take the gains and find something else that has a better supply-demand equation. That's really the best way to do it, to me. Okay, Godwin, fire away. What you got? We can't hear you. I don't know. For some reason, there's a technical issue there, I would say. Can you type it in the chat? If you do, I will answer it there. Jason. Last time the VIX was this low, February 2020. I'll tell you what I think of the VIX. The VIX to me is a lagging indicator. The VIX is a consequence of things that are occurring, not a predictor of things that are coming. I know that everybody looks at the VIX. If anything, to me, low volatility is a problem. The weaker that volatility becomes, the more the market making opportunity for profit diminishes. I count on a separation between an ETF and a basket of stocks, or stocks and derivatives, as a statistical arbitrager, a stat arb, to produce returns. And as a market maker for ETFs, I need some volatility. As that all goes away, my motivation to continue to make markets and expose myself to risk diminishes. So if anything, to me, volatility reaching lower levels probably is a sign of some impending change. It's not always true. I could, point it to go back to 2017. We ran for very, very long periods with very, very low volatility, and nothing happened. The market continued to rise. So is VIX useful? It's not that useful to me. I am much more disposed to look at broad sentiment and the context. To John's point, if we're rising, we have a little more than a week to run into options expirations. Round 2 of the Russell rebalances is tomorrow, but it's occurring now. I mean, you can't jam everything into small caps in a short period of time. And I think that part of the reason the Russell 2000 is performing well right now is because guess when the Russell rebalance began? June 2. Right? So if I've got to have, we're underweight small caps, we're going to have to move some money into it. Well, what's that going to do? It's a tiny slice of market cap, 5% of market cap. You put any increase, 20 basis points of increased demand into 5% of market cap, and boom, it goes up, and everybody then misinterprets that to mean, wow, man, the small caps are really outperforming. Must be a signal of growth. No, it's not. It's a rebalance effect. So I much prefer these things. If demand's rising and supply is falling into options expirations next week, great opportunity to produce returns, but then be very cautious. If this were to pop above 6, and it hasn't happened since April, basically April options expirations right into them, then I think we have to become much more cautious. There's a greater probability that coming out of all of this, these great runs for tech stocks, the rebalance in the Russells, the quarterly S&P rebalances, which will occur on or about next Friday, options expirations, that those things are better to me than the VIX by far. The VIX is a consequence of change, which boosts volatility. And it tends to only happen on the way down. Do you notice that when the market rises, volatility declines? That's because it's easier to get money into the market than to get it out. And there are other explanations too, but that is how I think about it. Anybody want to weigh in on that? No? Okay. Well, then that I think is a pretty good stopping point. That I think we have some momentum opportunity here. It's clearly in the data. If you look across the dashboard, you look at the supply demand curves. I look at these. Taking this, by the way, dropped from 130-ish to 78. But I look all across the dashboard. Big tech looks good. Everywhere you look, the supply demand equations look pretty good. They can change fast. Broad sentiment, same thing. Momentum's got 19 in it. All of those things say to me, we have a number of days probably where we can produce some good returns. But as we approach options expiration starting Thursday, and there's this Fed, what's the Fed going to do? Probably nothing on Wednesday. But beware of those things, that we're at a potential inflection point, and we'll watch the data to see how those things change. But I think that is a great way to have your eyes open and beware of what's occurring. Good enough for
Tim,
today?
Godwin did have his question out there in the chat room.
Okay. Let me get to you. And Tim, I'll address what you said too. John, you've mentioned Kim Carson. That guy's gotten pretty big. He's gotten some real attention. Looking for on a demand side to enter a trade between 8 and 10. Well, that's a great question, Godwin. So let me, I'll tell you the Hicks rule, which comes from Steve Hicks here. The Hicks rule is, and if you looked at the data, there's really only one that has these characteristics, and I didn't think they were awesome today because there's not a big decline. But ideally, and why the reason we say this is because mathematically, looking at the data, studying what happens, there is a very high consistency to entering a trade when a stock first arrives at 10. So that's why it says 10 and up. It just means that it spent one day at 10 and it was previously below 10. So that's why there's a 10 and an uptrend. It can only exist on a single day, that condition. So, here's optimal. It's up, and the price was even down, and supply declined day over day. This is the weakest element to me. It's not a big decline, but that's a pretty good condition. Again, you'd always check, is MDB reporting results? But that's what you look for. But by the same token, I could look at Roku, and I highlighted that in the market desk note today. It's been at 10 a number of days, but look at that big drop on the supply side. And of course, the price moved immediately. There could be other factors. It may have been news that drove that, but you can look at the supply demand equation and say that's very, very good. If Roku's a little weak, probably buy that, particularly to follow Steve's point. If you have 6% volatility, if it were down 3%, that would be perfect. Down 3%, it's a 10, supply's fallen, and then put in your, I'll exit, I'll take my 3%. Maybe you can get more than that, but why? You can wash, rinse, and repeat, and it's just very joyful to consistently make money. It is not joyful to lose money. So you might as well take the gains. But those are examples of exactly what to do. And the math here will give you some pretty good choices. They're not all that are out there, but they're pretty good ones. Even Ford, consumer discretionary, that is pretty good. It just got to 10 and supply dropped below 50%. Can Ford continue to deliver gains? Well, probably. Now, I realize it's a news-driven event, but if it pulls back a little bit with that supply-demand equation, could you get a little more? Yeah, probably could. Not only moves 3%, but could you get 3 or 2%? Yeah, probably. That's the way to think about that to me. Okay, any other words of wisdom, and we'll wrap up. Oh, wait, Tim, I said I would answer your question too. What was that again? Oh, yes, 0 days to expiration. I absolutely do think those have an effect. Yeah, and people are selling that as a volatility tool. That you could sell those against your portfolio, or not volatility tool, as a yield tool. I do think they distort the data some. They don't distort supply and demand. They distort prices. There's not an underlying movement in an actual asset, but yeah, I do think it has an effect. Okay, move 2 or 3. Where do you measure from? And maybe we didn't fully answer that question. I know, John, you said that. Is it from where it opens? I mean, if a stock opens up 3% from where it was yesterday, to me that is, and it has 3% volatility, that to me means it's moved all of its volatility. That's what I feel. But if it reverts to 0, I might buy that. I might, because is there a probability that it gets it back? Yes. And that would be an exception to buying it down half its volatility. I think it's all about how it moves in the day, whether that happens between the closing price and the opening price and a big move, wherever it is, that is volatility. And I think that's how machines would read it too. They're going to calculate trailing. We've seen this over and over. They calibrate things off of 20 trailing days worth of data. It's not a bunch of history. They're very short term. They're looking at how those things are changing over time. How do we know that's because we've measured the data and seen its effects, helping public companies. Okay, we went long, I know, but I was late. So maybe that makes it okay. As ever, good to see you. I will look forward to doing this again next week, I believe. I think so. I've got friends coming in on next Thursday, but I'll be back in Steamboat. I think I can squeeze this in, so I'll see you then. Have a good weekend.